Good evening. It's again my privilege to welcome you all to the update on the quarterly performance of Reliance Industries Limited. At the very outset, let me state that we had another excellent quarter for the period ended December 31, 2018. We set several records in this quarter, and I will begin by talking about net profit of 10,251 crores. The first time we have crossed that landmark for net profit on a consolidated basis, and also it's a record for private sector company in India. It's also a record for the corporate sector on a business as usual basis. With this, of course, we had a record EBITDA of 23,800 crores, roughly 20% up year on year. Within our businesses, our petrochemicals business also had a record EBITDA. Our digital services business under the brand name of Jio had a record EBITDA quarter, and so did retail. As far as our refining and petrochemicals businesses are concerned, we saw volume growth quarter on quarter in both refining and petrochemicals. We also see this as a quarter of high volatility in the energy business, and the results reflect a robust earnings performance despite a challenging environment. Our consumer businesses now account for nearly 25% of EBITDA from less than 2% 2 years ago. In terms of operational performance, the petrochemicals had the highest throughput at 9.7 million tons. In terms of refining, we had a GRM of $8.8 per barrel, a premium of roughly $4.50 per barrel over Singapore complex. Again, one of the better performances in terms of comparing with Singapore complex margins. In Jio, we crossed the subscriber base of 280 million as of December 31, another important landmark for us. And the hyper-growth story in retail continues, and we now operate over 9,900 stores across 6,400 towns and cities and nearly 21 million square foot of retailing. This quarter had a lot of volatility, and if you look at oil prices, we saw one of the steepest falls in history in a quarter. Brent declined from nearly $85 per barrel to $50 in this quarter. The rupee also on an average basis depreciated by about 3%. Both of these imparted a level of volatility and uncertainty in the product markets, and so we saw that in a very muted growth in demand of only 2% in polymers and a demand pressure of nearly 8% as far as polyester is concerned. In the transportation fuels business, overall demand growth was nearly 2%. Diesel was just under 2%, whereas gasoline growth was nearly 8%. On the other hand, as far as our consumer businesses are concerned, we saw solid customer subscriber addition, and in the festive season, we saw footfalls of nearly 57 million, which is about 25% higher year on year. So in a nutshell, while the energy businesses had some impact coming out of volatility, the consumer businesses continued to do exceptionally well. A brief review of our businesses before we get into them in detail. In our petchem business, record EBITDA of 9,596 crores, up nearly 37% year on year. A record production of 9.7 million tons, up nearly 16% year on year. When we look at this quarter and we look at EBITDA growth came from higher volumes in polyethylene, polypropylene, and to some extent in paraxylene and PTA. We also had the benefit of lower feedstock prices, both naphtha and propane. Naphtha was on average 15% lower than the previous quarter, and therefore we saw margins expand primarily in paraxylene and polypropylene, but we also saw some negative impact of this in the rest of the polyester chain in POY and PSF. Having said that, integrated polyester margins stayed well above 5-year averages. In refining, a softer quarter, EBITDA of 5,849 crores, down 4% quarter on quarter, throughput of 18 million tons during this quarter. This quarter was really marked by a very sharp contraction in gasoline spreads. They dropped by nearly $7 per barrel, and given on the full production, that is equivalent to over $2 per barrel reduction in gross refining margins. As far as benchmark Singapore refineries are concerned, the drop in gasoline was to some extent offset by the strength in fuel oil, but overall still a negative performance. As far as we are concerned, we took the headwinds of lower gasoline margins and higher fuel oil costs and offset that by stronger middle distillates, changing the crude mix, going for a lighter crude slate, sourcing more crude from the US, tight risk management, and operating the plants to the highest possible 18 million ton throughput. We also had our retail outlets continue to improve the throughput, and we continue to lead the industry in terms of volumes per outlet. Upstream, a slightly better quarter than the previous one, with EBITDA at 511 crores. Essentially, as we have given up the FPSO, their hiring charges did come down. We also had slightly better gas realizations both in the domestic and the US markets. And most importantly, our development project is on track, and we do expect gas in the second half of 2021. As far as Geo is concerned, revenue of 4,053 crores in this quarter and net profit of 831 crores. We are India's largest wireless data subscriber base of 280 million subscribers. ARPU stayed stable at about 130 per month, and we continue to lead in terms of data consumption and have 71% share of 4G data traffic. In retail, EBITDA at 1,680 crores, up 177% year on year and 21% quarter on quarter. Turnover at 35,577 crores. We opened 780 new stores in this quarter, and as I said, we have ubiquitous presence across 6,400 towns, cities, 9,900 stores and 21 million square feet. With that, let's look at the consolidated financials. Revenue at 1,71,336 crores for this quarter, up 9.6% sequentially. EBITDA at 23,801 crores, up 6.4% sequentially. Depreciation stays virtually flat at 5,237 crores. Interest costs slightly higher at 4,119 crores, 4.8% higher than previous quarter. And net profit up on a consolidated basis 7.7% at 10,251 crores. So when we look behind these numbers, the revenue growth clearly has come from the higher volumes both in refining and petrochemicals, and of course the higher revenues coming out of our consumer business. Interest costs are slightly higher because of higher borrowings, and depreciation remains flat. Consolidated return on capital employed at 13.2% on an adjusted basis. When we look at the breakup of EBITDA consolidated basis, now 25.4% of consolidated EBITDA came from our consumer business. Petrochemicals had the largest share of 42.4%, followed by refining at 25.8%. Crossing 25% of consolidated EBITDA by our consumer businesses is a significant landmark for us, and we can hope to see continued growth in this metric. Looking back again, our refining business, 2018 was a good year. Global oil demand growth expected at roughly 1.3 million barrels per day. We saw growth in In the US, we saw growth. In Asia, we saw growth in non-OECD countries. And at the same time, towards the end of the year, calendar year, we saw headwinds, as I said earlier, from both volatility in crude prices and low gasoline demand. US refiners operated at 95 to 96% during this period and added to the gasoline inventories. As far as the Asian markets are concerned, the low gasoline spreads were compensated to some extent, but not fully, by middle distillate cracks. They were also impacted by lower spreads for naphtha and stronger fuel oil. All in all, Arab light heavy differential was relatively stable. The other positive thing for complex refining was that Brent in Dubai narrowed. So that offset to some extent the impact of stronger fuel oil. So all in all, a tough quarter for refining, but we proved the fact that we operate some of the best refining assets in the world and had a very resilient performance marked with a $4.5 per barrel spread over Singapore complex. As far as petrochemicals are concerned, as I said earlier, it was a record quarter. The financial performance reflects volume growth and reflects positive margin environment for some of our key products, polypropylene and paraxylene. We saw the growth in polyester chain production was the highest, thanks to paraxylene, PTA and MEG. When we look at paraxylene spreads, $547 over naphtha, among the highest we've ever seen, and 75% higher than what we were seeing last year. PTA margins, though, were slightly softer than previous quarter, but at $184 realized, they are about 46% higher than what we saw in the previous year. MEG margins, on the other hand, were lower, and at $374 were about 30% lower than what we saw a year ago. Integrated polyester margins, well above the 5-year average. They are a touch lower, 3% lower quarter on quarter, but a full 13% higher than what we saw a year ago. So the polyester chains did really well, both in terms of volume growth and higher spread in paraxylene. As far as polymers are concerned, a softer demand environment that we talked about. We did have the highest ever quarterly production of polypropylene. We also saw sharp recovery in polypropylene margins. Polyethylene was basically flat, though margins were slightly better due to lower naphtha prices, and PVC margins was lower because of higher feedstock prices. So if we take all that together, we still had the best quarter in petrochemicals, both in terms of production as well as EBITDA. As far as upstream is concerned, we talked about the oil price situation. The domestic production was 13.2 BCFE, down 13.9% quarter on quarter, natural decline. Unit realization was flat to slightly higher. US shale production 20.9 BCF, down 1.4 quarter on quarter, so essentially flat, but slightly higher realization. And CBM production was flat at nearly 1 million cubic meters a day. Retail was and continues to be a hyper-growth story. Just let's look at the numbers to see how strong growth was. In terms of revenue, in excess of 35,500 crores, up 10% quarter on quarter and up 89% year on year. In terms of EBITDA, at 1,680 crores, up nearly 21% quarter on quarter and up 177% year on year. With the growth, we also had margin expansion. EBITDA margin for this quarter was 4.7% as compared to 4.3% in the previous quarter. So we had both higher revenues along with higher margins. We added 780 stores gross during this quarter. So we were opening on average more than 8 stores per day. We added nearly 1.1 million square feet in terms of retail space, and closed the quarter at 20.6 million square feet. We also added 6 lakh tons of new warehouse space to basically build out the supply chain and infrastructure. And we had the highest ever footfall in a quarter at 139 million people. On Jio, we are listing more and more products and now have 115,000 products listed on it. So in summary, Reliance Retail's revenues are higher than all other organized retailers in the country. Its stores are higher than all other retailers combined in the country, and we are beginning to see the benefit of scale, logistics, customer experience and footfalls. Jio is also on a high growth trajectory, and the numbers bear that. The number of subscribers as at the end of December were 280 plus million. We added a net of nearly 28 million subscribers in this quarter. ARPU was stable at 130 compared to 132 in the previous quarter. Gross revenue was up to 12,252 crores in the quarter, up 12.4% sequentially and up 51% year on year. EBITDA was 4,053 crores, up 13.4% quarter on quarter and 54% year on year. These are exceptionally strong growth numbers. EBITDA margin stayed flat, actually improved by 30 basis points and is now 39%. Data traffic continues to grow quarter after quarter, and the data traffic in the last quarter was 8.6 billion GB as compared to 7.7 in the previous quarter. Voice traffic continues to grow again quarter on quarter, and the voice traffic in this quarter was 6.9 billion minutes compared to 5.8 in the previous quarter. Voice consumption per subscriber per month 794 minutes as compared to 761, and data consumption stays flat at about 10.8 GB per month. So this is really the customer traction, this is really the customer acquisition story in Jio with stable margins, and we are now beginning to see operating leverage come through as we are getting more subscribers with improving margins. We can also proudly say that we have undisputably the best network quality in India with the lowest call drop rate, lowest monthly churn, best download speeds and 100% network availability. So as we look at all our businesses on a consolidated basis, the concluding comments that I would make is that our energy business, which comprises primarily of refining and petrochemicals business, has demonstrated again that it can give a resilient, improving performance even in a tough, challenging and volatile environment. Our retail business is probably the fastest growing retail business in the world, and it is also now undisputably the largest retailer in India with the best metrics. We are making rapid progress in Jio, both in terms of customer acquisition, in terms of stability of ARPU and improving EBITDA margins. And with that and the number of 23,801 crores in terms of consolidated EBITDA, we are well on our track to get to 1 lakh crores annualized EBITDA as we close out this financial year, and that would be another landmark for us. Thank you very much.